Well, it happened again, at least a little. Welcome to the Grand Rapids, Michigan, Kent County residential real estate market update with data through February 2023. My name is Rodney Constable. I'm a realtor with 616 Realty out of Grand Rapids, Michigan. Year over year, home prices fell 0.9% versus the same period 1 year ago. So this is the second month in a row where we've seen a slight, and guys, these are slight decreases, right? This isn't a massive difference between what homes were selling for same period in 2022 versus what we're looking at right now. But for 2 months in a row, January, if you watched my last video, if you haven't, please watch it. But if you looked at the January video, and now this is the February data, we have had 2 months in a row where compared to the same period 1 year ago, home prices are down a little bit in the Grand Rapids area. Year to date, the average home in the Grand Rapids area is selling for $320,139. 1 year ago in 2022, and again, we're looking at January and February of each year here, and we'll go over real quickly these 8 years of data that we have, but we can see that in January and February, the average price for the first 2 months of 2022, the average house in the Grand Rapids area was selling for $322,991. Right now, we're at $321.39, so the difference is $2,852. So on average, the average home in Grand Rapids that is sold, the closed transactions for the first 2 months of 2023 are averaging $2,852 lower than what they did for the first 2 months of 2022. However, if we look at 2021, 2020, we can see that we have steadily risen. And you can, if we go to the bottom of the chart here, right, the data goes back to 2016. This is as far back as I have this data set. So we can see that we had a steady increase year over year. And right now we're down less than 1%, guys, 0.9%, right? So $2,852. That is not a huge decline at all. So if anybody's concerned about housing prices cratering in the Grand Rapids area, is it possible? I suppose it's possible, guys, but I don't think it's very likely, right? And you'll see as we go through this presentation, and if you've watched any of my other videos, and if you haven't, please go back and look at them. But we just don't have the inventory, right? There's just not an excessive amount of homes in the Grand Rapids area that are available for sale. And as you'll go through the presentation with me here over the next few minutes, I think you'll see that if anything, the market is going to continue to get tighter, and we're probably not going to see a substantial decrease in home prices in the Grand Rapids area anytime soon. The average home is selling after being on the market for just 30 days. When we compare that to the inventory of unsold homes, we can see that those homes have been on the market for an average of 80 days. What these two data points tell us is that if a home is properly priced, even in this market, right, with rising interest rates, it will sell in a relatively short period of time, on average in about 1 month. However, if the home is not properly priced for its location, condition, and amenities, it will stay on the market for an extended period of time, right now just under 3 months. Next, let's turn our attention to year-to-date new listings versus the same period 1 year ago. And in this category, we are down 5.7% year over year. When we look at this in a numerical format, what we can see is that so far for the first 2 months of 2023, there were 926 listings that had come to market in Kent County versus 982 for the first 2 months of 2022. That is 56 fewer homes, or 5.7% fewer homes listed during the first 2 months of 2023 versus the first 2 months of 2022. Now, when we work our way down the chart, we can see that for 2023 so far, guys, this is by far the lowest amount of listings that we've had come to market for the first 2 months of any year over the last 8 years, and that includes 2020, right before COVID, and then even 2021, right? We were still in COVID, obviously. 2022, we can see we had a drop off there, and then 2023, it's even lower still. All right, and real quick here, just to address the interest rates and how this might play into what's going to happen going forward. 85%, based on the numbers that I've seen, 80 to 85% of all people with a mortgage, right, any homes with a mortgage, and keep in mind about 38% of all homes across the nation are debt-free. They're mortgage-free, all right? But for those homes that are mortgaged, and if 38% of homes don't have a mortgage, then 62%, right, 60+% will have a mortgage. Of that 60+% of homes with a mortgage, 80 to 85% of all of those homes are financed sub 4%. So, in other words, if the 30-year mortgage is 6 to 7%, which is where it's been playing around right now, those people with a 4 or even a 3% mortgage are not going to want to go out and sell their home, even if they want a different house, even if they want to move, right? Unless they absolutely have to move. And generally, the have to moves are going to be, either divorce, job change, or death. And so we still will see those transactions. But if somebody just wants to move, unless they really have to, a lot of people that own a house right now are going to be very hesitant about putting their house on the market, because if they do have a mortgage, they're going to be giving up, a 3 or 4% mortgage, and in exchange for perhaps a 5.5%, 6.5%, 7% mortgage. All right. And I'm going to do a separate video, guys, so look for it, or go back to last month's video. I didn't put the chart in here this month, but I went through the last 50 years of the 30-year mortgage. And, guys, even though mortgages are higher than what they were over the last few years, they're about average for the last 15 years, okay? So it's called regression to the mean. Keep in mind, I've got an extensive background in financial services in addition to being a realtor. So it's just, me being a finance geek, right? That's finance speak, but it's called regression to the mean. In other words, we had artificially low interest rates, guys, bear with me. I know this is maybe a little bit boring, but this is super important for you to understand. We had artificially low interest rates for many, many years, right? Artificially low. Okay. Think about that phrase, artificially low. Now we're back to a more normal interest rate on the 30-year mortgage, and people are just going to have to get used to it, right? Because I'm going to encourage you not, if you want to own a home, guys, don't wait for a 3% mortgage again, because we may never see that in our lifetime again. And I'm being serious, okay? It's just it wasn't normal. We probably won't see that again in our lifetime, and I'm being very, very sincere about that. The math just doesn't add up, okay? And when we look at the year-to-date new listings, what I'm explaining to you kind of is playing out here, right? If you go down to 2016, there was 1,512 new listings that came to market in the first 2 months of 2016, and you can see we had 1,300 and a little over 1,300 in 2018, 2017. We dropped down to 1,265 during the first 2 months of 2019. You may remember 2019 when we had a ton of snow in January, February, so I think that hurt us there. And then right before COVID, right, because remember, COVID really hit in March of 2020, we had 1,403 listings come to market. And then each year since 2020, you can see we're going lower and lower and lower. So there's fewer and fewer homes coming to market, less inventory, less homes for people to choose from. And as long as the demand for homes in the Grand Rapids area stays strong, and it is strong from the buyer side, we're going to continue to see, I think, housing prices hold up fairly well, and perhaps even rise over the next couple of years. Okay. Now, one last thing, real quick. Cash buyers, and I just the most recent close that I had was an all cash deal. All right, so cash buyers, it doesn't matter to a cash buyer whether the interest rate's 3% or 7% on the 30-year mortgage, right, or 15 or whatever you're looking at. The cash buyer doesn't care. So it actually strengthens the cash buyer's position, because there's going to be fewer and fewer people competing, right, for that same home. So just think about that as well, guys. I know I'm throwing a lot at you, but this is so important, guys. This, understanding and going through these videos, and I know I'm a lot more detailed than most people, and I hope you appreciate that. I want to work with you. I hope by going through this video, you realize I know what I'm doing and I can help you, right? But it's important for us to understand this, because for most people, your home is going to be one of, if not the most important and expensive purchase you will ever make. An investment for a lot of people. It'll be your largest investment, be your largest purchase, the most expensive thing you ever purchase in your lifetime. So it's important to understand how this works and have realistic expectations about what's going to happen in the market, okay? All right, so let's move to year-to-date closed transactions. Now, this is really where the rubber meets the road, all right? So we've looked at pricing, we've looked at listings, but now let's look at the closed transactions and what we can see, and these are actual homes that have sold during the first 2 months of this year compared to the first 2 months of last year. We're down 7.46%. Now, again, a lot of that is rising interest rates, right? A lot of people have been priced out when the interest rate goes up. People can afford less home. And so even though housing prices have stabilized, right, within 1% of where they were last year, there's still fewer and fewer people that can qualify for that same home, right? Especially if they're going to be financing. Now, again, a cash buyer doesn't matter. But for those people that are financing, and most people do finance, right? Most people use a 30-year mortgage. Obviously, you're not going to be able to afford as much house. I mean, that's just the reality of it, okay? So what we can see here is so far for the first 2 months of 2023, there were 856 closed transactions in Kent County versus 925 last year. That's down 69 homes or 7.46% differential. If we look at 2021, there were 1,072 homes, 1,153 in 2020, and you can see we had a slight drop-off there in 19 and 18, right, where we were, just shy of 1,000 homes. But in 2017, 1,078 homes for the first 2 months. And guys, in Grand Rapids, in Michigan, and Kent County area, January, February are not the hot months for selling, right? It starts picking up in really March, April, and then June, July are really May, June, July are really the hottest months for selling, right, for closed transactions. That's when most of the deals from a percentage standpoint and the real volume spike happens. So I just want you to understand, that we're in a slow period for sure, but you can clearly see that over the last 8 years at 856 closed transactions, this is the lowest volume, the lowest number of closed transactions we've had for the first 2 months of the year for the last 8 years, okay? So all of this is contributing. Now, and this is one of the things people say, well, the housing market's slowing down. Well, yeah, but it doesn't necessarily mean housing prices are falling a lot, all right? We're talking about the real estate industry itself here, right? There's fewer and fewer closed transactions, fewer and fewer homes coming to the market. So the real estate industry itself might be slowing down, but that doesn't necessarily mean housing prices are falling a lot. As we've seen, year over year, we're down less than 1%, okay? That is a very negligible amount, all right? So again, is it possible anything could happen, right? Is it possible, housing prices could pull back more? Yes, but it's not very likely because we just don't have the inventory. We're not seeing a lot of new homes being built, especially in, the sub 300 price range. And we're also where obviously the average house, right, is selling 320, and lower. And also those people that, the pre-existing inventory, which makes up the bulk of all the houses sold throughout the nation, right? And, no difference here in Grand Rapids. So, most houses that are sold are not brand new homes. They're pre-existing homes, right? They're, it's somebody's already lived in it, right? And if there's fewer and fewer people that are willing to put their home on the market, there's going to be less inventory for people to choose from. All right, so with that said, let's take a look at the average months of inventory in Kent County. Now, for 2023 so far, again, first 2 months of the year, we're averaging 1 month of inventory. That's 30 plus or minus days, okay? So what this means is that if no new homes came to market based on our current sell rate, we would be completely sold out of homes in the entire county of Kent County in about 30 days. Now, last year in 2022, we averaged about 27 days, 0.9 months of inventory. And then in 2021, it was really bad at about 18 days, all right, 0.6 months of inventory. But even at 1 month of inventory, yes, it's higher than what we were averaging for the last couple of years. And by the way, this is full year data now other than 2023. So we're looking at the entire years, right? This is what we finished up, except for 2023. That's just the first 2 months of the year. My point is calendar year 2022, we ended up 0.9. calendar year 2021, we ended up 0.6. I just want you to understand that's how this data is ran. But if we go down and look at 2014, 2014 was the highest inventory level that we've had. And by the way, I've got over 10 years of data here. So I run this back to 2013. I've got a few more years of data available to me on the average months of inventory. So I run this data back just a little bit further. What we can see is in 2014, we had 2.3 months of inventory. Okay, that's the highest inventory level that we've had in over a decade. And guys, I can tell you that 2.3 months of inventory is still really, really low inventory, let alone where we're at right now at 1 month of inventory. So why does inventory matter? Well, as we can see here, if you have between 1 and 2 months of inventory, you probably are going to experience double-digit price appreciation on homes. And that is exactly what we have seen for many years here in the Grand Rapids area. If you're running between 3 and 4 months of inventory, you would generally experience single-digit price appreciation. If the inventory built to where you had between 5 and 6 months of inventory, this is more of a normal, balanced, or neutral market where you might experience some price appreciation, but it would more than likely be in the low single digits. And if you're under 5 to 6 months of inventory, this is considered a seller's market. And that's exactly what we have seen for many years here in Grand Rapids. If you're over 6 months of inventory, this is considered a buyer's market. And if your inventory built to between 7 and 8 months, that's when you would most likely experience single-digit price depreciation. And then if the inventory built to 9 months plus, that's when you would likely see double-digit price depreciation. So 7 to 8 months of inventory, single-digit price depreciation, 9 months plus, that's when we start to get into double-digit price depreciation. Are you looking for a realtor you can trust? If so, look no further. When you are ready, let me put my decades of sales and business experience to work for you. Call me directly at 616-258-4782 to discuss your situation or to just talk about real estate. I look forward to helping you succeed. Once again, that phone number is 616-258-4782.